Right.
Yeah,
I'm Lindsay Avery, mortgage advisor in the Consumer Direct division. And what we thought was just to go over adjustable rate mortgages. I know it's something that really, years ago, very popular product, but really ever since the mortgage meltdown of 2008, our rates just kept going down. So for years and years now, we've been in a fixed rate market. Is everybody familiar with adjustable rate mortgages? I'll just go over basics on just the workings of how an adjustable rate mortgage operates. A few key things. Obviously the difference between an adjustable rate and a fixed rate is the fixed rate is fixed for the entire term of the loan, whether it's a 30-year term, 20-year, 15-year. Adjustable rate mortgage is just that. You have different options. The options that we have here at Weichert, you can either do a 5-year adjustable, 7-year adjustable, or a 10-year adjustable. What that means is that the initial interest rate, normally called an introductory rate, is fixed for either the first 5 years of the loan, the first 7 years of the loan, or the first 10 years of the loan. After that, this particular adjustable adjusts every 6 months. So an adjustable has features to it. It has an index, it has a margin, it has adjustment caps, it has a lifetime cap, and also a lifetime floor for the interest rate. Let me know if this is too confusing for you, or if you already know this information. But anyway, if your customer chooses, say, the 5-year adjustable, and I'm just going to use round numbers just for simplicity, they lock into a rate of 5%. After the 5th year, that rate is going to adjust every 6 months. The index that we're using now, it's something relatively new in the market. It's called the Secured Overnight Financing Rate, SOFR. It used to be the 1-year Treasury index, then it went to the LIBOR. Well, something happened a few years back where apparently somehow smart bankers were manipulating the LIBOR index. So the government stepped in and did away with the index. And now the new index that we use is this particular index. I won't even go into the compilation of it, but it's an index. So you have your index and you have a margin. I call it the bank's profit margin. So when that loan is going to adjust, the lender will look at whatever the index is at that point in time when it's time for adjustment and add a margin. That will determine the new rate. But what the loans also have to protect customers from a huge rate increase, it's called adjustment caps and a lifetime cap. So say, for instance, customer locks into the 5-year adjustable. If the rate was locked in at 5, there is a 2% per adjustment cap. So that means the first adjustment, if their interest rate is 5, you would add 2%. So the maximum their rate would be 7%, that first adjustment period. Thereafter, it has a 1% adjustment cap. So I know it gets a little confusing, but when it comes to customers, I like to thoroughly explain this so that the customer fully understands what they're getting themselves into. So that particular product has the adjustment cap of 2, 1% after the first adjustment, and then it also has a total lifetime interest rate cap of 5%. So that means during the course of the whole term of the loan, the rate could never exceed 10%. So again, you have the features. You have, in the way adjustables work, you have the index, you have the profit margin, and our margin today on this product is 2 3/4. So the only variable feature, once the loan goes beyond that fixed rate period, the variable feature is the index. That is what changes each and every time you're going to adjust. The margin is a constant. The lender will always add the 2 3/4 to the index, and your caps are constants. So that's why they call it a variable rate. There's also an interest rate floor, meaning there's a minimum interest rate that it could ever go down to, and that's 2 3/4. Let's let's see, what else? Oh, well, again, there's like another term. When you add the index plus the margin, that's called the fully indexed rate. And as far as qualifying people, this goes way back. I call it the Dodd-Frank Wall Street Reform Act. There were different ways of qualifying adjustables, which were years ago easier. Now, when it comes to qualifying people, it's a little bit harder. For instance, say on the 5-year adjustable, they locked in at a 5% rate. We may not necessarily qualify them at that 5% rate. So on the 5-year adjustable program, we will be qualifying them at either, and it's always the higher of, the first adjustment rate or the note rate, whichever is higher. So if we go back to the 5% rate, if we have a 2% first adjustment, what would be, number one, the maximum rate? 7.
Yep.
Yeah, 5 plus the 2, that's 7. So the maximum first adjustment rate is 7. So they look at that, the underwriter will look at that, and the underwriter will look at the note rate, 5%. They won't be qualified on the 5%. They'll be qualified on the 7%. So that makes a huge difference in qualifying. The 7 and 10 year work a little bit differently. The 7 and 10 year have a 5% first adjustment cap, which is pretty high because, again, and believe it or not, all the rates are about the same. Their rates actually are the same for all 3 programs. So same thing. Say you have a 7-year or a 10-year arm. If you lock in that rate at 5%, after the 7th year or after the 10th year, you're looking at a maximum rate of 10%, that very first adjustment. And then thereafter, it has a 1% adjustment cap. It also has a 5% total lifetime cap. We could do terms of 15 or 30 years. Weichert's adjustables, the minimum loan balance is $400,000. Qualifying on the 7 and 10 years a little bit easier. It doesn't go off of the first adjustment cap because that's pretty high. What the underwriter will do is they will look at the fully indexed rate at the first adjustment. And again, the fully indexed rate is your index plus your margin. You add that together, and that's called the fully indexed rate. So 7 years down the line, if the index is at 2 and the margin is at 2 3/4, that would be a new rate of 4 3/4. The cap, I'm sorry, we locked in at 5%. So actually they would be qualified at 5%. So it's always the higher of what the fully indexed rate is or the note rate. And that's what, oh, I'm sorry.
I was gonna say, Linda, what is the kind of like the current typical 30-year fixed versus a
okay, I'll tell you what's going on today, where ARMs aren't really working for us today. The rate is, but the points aren't. I just did, like, say, a $400,000 loan, 80% loan to value, $500,000 purchase price. Our 30-year today is at 7 1/8. The adjustables are at like 5 1/2, but the points are, they're very, very high on the points. And I think it just has to do with what's going on in the market. So this actually is a program for like down the road. What happened was too, because we haven't been in an ARM market, a lot of lenders pulled out. And like I said, it all goes back to that index as well, because there were things going on in the market with the LIBOR index. Fannie Mae and Freddie Mac stopped purchasing that particular type of ARM. Then the government came in and actually abolished that index, and they came out with this new index. You know, I've been in the business for years. I was never a proponent of adjustables, but again, it's where you are in the market. You may have somebody that is only going to, maybe they just want to be in the home for maybe 5 years or 7 years. And for them, that lower interest rate makes sense than paying a higher interest rate. So that's definitely a pro. The cons, it's a variable. They could do away with this index, you don't know, 10 years from now, and then have to substitute it with a different index. There are a multitude of indices out there. A certain index may be more stable than another index. So I know it gets a little involved, but when it comes to adjustable rate mortgages, there are as you can see, so many different factors and features that really the consumer has to be made aware of. There is a program description that goes out to the customer once they apply, and it spells out all of the features of the loan, the index, the margin, your caps, how it adjusts. Once the customer closes, this is all put into their note, and it's all spelled out in the mortgage note, all of this information, so they could always refer back to it.